This term bond denotes a kind of negotiable debt instrument. So what it implies that whenever an institution is in need of debt funds, that is, they want the leverage funds with fixed financial cost in the form of interest. So either they can issue the debentures where the debenture having a face value can be issued either at discount or at or at premium, depending upon the conditions of the market. Then, during the life of the debt instrument, yearly interest as promised will be paid irrespective of the profits. And then the redemption of the debentures will take place, ideally at the face value, or if the company wants to reward such debt holders because they helped the company by providing funds in the time of their need. So, in some cases, the company redeem them at premium. Now, whatever the case may be, but when we compare it with the bond, so that we can understand the meaning of the word bond valuation, bond like debentures will have a face value. So, if a particular bond is for a face value, say rupees 1,000, and it has a life of say 5 years. So basically, what is happening that the bond will be matured after the maturity period for rupees 1,000, obviously, and in some cases, the yearly interest will be paid like the debt instruments. So if the bond is say 8% bond, it denotes that on a face value of 1,000, 8% interest, that is 80 rupees interest each year will be paid for the life of the project each year, payable annually at the end of the year. So N3, N4, N5, these five will denote the interest payments. But the point is that at what price the bond shall be sold. So unlike debentures, they are not issued because there is a register of debentures where the list of all debenture holders is made. But in the case of bond, they are negotiable. So anybody can buy the bond, and once they have purchased the bond, they can sell it before maturity to anyone else. So as such, there is no record of the bond holders in the records of the company. So bond will be issued at par of 1,000, at discount, or at premium, and this decision will be taken depending upon what is the expected return of such investor. Because the company has promised a return of 8%, whereas in practical life, the expected return for the financier or the common investor can either be 8%, can either be more than 8%, or it can either be less than 8%. So our point of view is that if the expected return of such investor is 8%, which matches with the interest payable by the bond, then such bond will be sold at the face value of rupees 1,000, and we say that the bond is available at par. But if the investors expect more than the 8%, then they will not buy the share, or sorry, this bond at 1,000 face value, because then they will be getting lesser returns. So in such cases, the bonds will be available at discount, and this discounted purchase price will increase the returns available to the investors, and hence their expected returns can be matched, or vice versa. If their expected return is less than this 8%, then the bond will be available at a premium so that the shareholders, sorry, the investors receive what they deserved or what they wanted. So, all these questions of bond valuation shall be pursued keeping in mind that what is the expected return or the cost of debt of such investors, and this expected return has to be compared with the bond interest, the bond returns, or we can say the bond interest, and their difference will decide at what price the bond is available in the market. So, if I take this an example, that a 1,000 rupee bond of 8% interest and 5-year maturity is available at a price of say 920 rupees in the market. So what is happening here? That the current investment of rupees 920 by an investor will give 5 interest each year of 80 each, and at the end of the fifth year he will get the 1000 rupees extra. But if the expected return of such investor is 10% per annum, so we have to decide whether this bond has been purchased at higher price, because if that is the case, then he will not get what he deserves. So either keeping in mind the returns required by such investor, we should calculate the intrinsic value of the bond. And this intrinsic value of the bond calculation is what you call bond valuation. And if this intrinsic value of the bond is more than the market price of the bond, then we can say that the bond is worth more than what it is actually available in the market, and hence you can decide about purchasing the bond or investing in the bond. Another way of looking at the way is that instead of calculating the intrinsic value of the bond, from the same data, we can calculate the yield, or I can use the word, we can calculate the bond yield. So, by using this current value of 920, the yearly interest of 80, and redemption of 1000, I can calculate the bond yield, which is also known as YTM, that is the yield to maturity. And if this yield to maturity is more than the expected return, it means the bond is available at a cheaper rate, or the investor is getting more what he wanted, and hence the bond shall be purchased. So this concept of bond valuation we will cover in two sessions in you on this our live YouTube channel, where either we will be calculating the intrinsic value of the bond, the intrinsic value of the bond, or we will calculate the yield to maturity. So in this session, I'm taking that above example to calculate this intrinsic value of the bond. And in the next sessions to come, we will try to calculate the YTM, and also in some cases where it is an option to redeem the bond before maturity, then we can use the word YTC, that is the yield to call. But the primary focus will be on YTM, that is the yield to maturity. So ideally, this intrinsic value of the bond, which can also be denoted as E0, that is the current price, shall be equal to the total present value of returns. And these returns will be in two form. One will be the annual interest, and the second will be the redemption value. We here will use the word RV, and these interest if equal each year, then it will be I. Sometimes there can be inherent tax saving, because whenever the interest is paid, it is paid before tax is levied. As we have discussed in our earlier sessions, that the operating profit, that is EBIT, will be first charged against the interest paid, and then we will get the earning before tax, and then tax is levied to arrive at the figure of profit after tax. So whatever the interest is paid either on the debentures or the bonds will reduce your taxable profit, and hence interest brings tax savings. So if tax is levied at the rate T, so if there is tax saving ignored, then we can take I, or if there is inherent tax saving, then interest of the word I, we have to deduct the tax saved on interest from this, and this tax saved interest will be I multiplied by the tax rate, and therefore this figure will this figure will be the redemption value, and this figure will be I minus IT, and that will come out to be I to be taken as common, that I 1 minus T. So what you will see from here that whenever we will calculate the present value of this annual interest, whether with tax saving or without tax saving or the redemption value, then this discounting has to be calculated at the expected rate of return, whatever the returns are expected by the shareholders. So if we take that expected rate of return as R, then we can say then this current price shall be equal to this annual interest, which can be I or I1 minus T, and this will constitute an annuity. So if we multiply it by the present value annuity factor for the rate of return and the number of years of maturity, then this will denote the present value of the annual interest after tax. And if tax is ignored, then in that case, question will not have the tax rate. So if we take T0, it will become I into present value annuity factor plus the present value of the redemption value, that is the present value redemption value, sorry, multiplied by the present value factor of rate of interest R, and that is the year of the maturity, and the total of the two shall be the value of the bond. So if we take the above example where the redemption value was 1000, the maturity was for 5 years, the bond was 8%, and if we take tax as 30% and the expected rate of return was 10% per annum. So in this case, the present value, that is the intrinsic value of such bond, will be equal to I, and I will be equal to 1000 into 8%, and that will come out to be rupees 80. So it will be 80 multiplied by 1 minus 0.30 multiplied by the present value annuity factor or at the rate 10% and for 5 years. So we can see this table from there, from the PVAF table, and this if added with the redemption value, which will be 1000 into PVF, and that at the rate 10% and 5. So this figure will be 56 multiplied by the PVAF figure plus 1000 multiplied by the PVF. So if we calculate the PVF, so this figure, that is the PVF, from the table you can see it is 0.621, and if we take the PVAF, then either we can see it from the table or PVAF is the sum total of 5 PVFs. So in the first case, it is 0.909. For the second year, that is the PVF for the second year is 0.826. For the third year, it is 0.751. For the fourth year, it is 0.683. And for the fifth year, it is as said 6.21. These are the 5 PVFs of year 1, 2, 3, 4, 5. And the total of these 5 will be the PVF at the rate 10% for N5. So if we take the total of all these three, so this figure is coming out to be 3.79. So here, this 56 multiplied by 3.79. So if we multiply this, then this is coming out to be 212.25, and this is coming out to be rupees 621. So the value is coming out to be 833.25. So this is the intrinsic value of the bond if the rate of return is 10%. So we can say that a 1000 face value bond That is the bond that will be matured after 5 years and will give you 1,000 rupees with 8% rate of interest. That is at the end of the first year, at the end of the second year, third year, fourth year, and fifth year, you will receive 80 rupees each. That will save you 30% tax, is worth only for rupees 833.25 now at year zero if the expected rate of return is 10%. Okay? So if the price, that is the market price, is above this intrinsic value, which in this above example was taken as 920, is more than this intrinsic value of 833.25, so we can say that the bond is expensive and so shouldn't be bought. So we in this way we can do the valuation of the bond. Now again, moving forward, if I just give an hint of how to calculate the YTM, so this yield to maturity can either be calculated on the IRR basis. So we will discuss this later on, but the shortcut of this calculation of YTM will always be that the YTM will be equal to the I that is being given 1 minus T plus the redemption value minus the initial current price, or we can say the current cash which is to be invested, known as B0, and this should be divided by the number of years of investment and the overall redemption value plus the cash proceed of the current year should be averaged to arrive at the YTM. So if we calculate the YTM for this question, so here the RV will be 1,000 rupees, the B0, that is the current price of the bond, which was set to be 920. The N will be 5 years. The I will be rupees 80 and the T will be 30, that is 0.3030%. So the YTM in this case shall be equal to 81 minus 0.3 plus the redemption value of 1,000 divided by, sorry, subtracted by the current price 920 divided by the number of years 5 and divided by the average investment, that is 1,000 plus 920 by 2. So you will see here that this figure comes out to be 56 plus this is coming out to be 16 and the average will come out to be 960. So you will see it is 72 divided by 960 and this comes out to be 0.075. So we can say that the YTM is only 7.5%. So if someone purchases this bond for 920, then the available yields will be only 7.5% against an expectation of 10%. So bond shall not be purchased. So in this way, we are aligning our decisions that either way of calculating the intrinsic value or calculating the yield to maturity, in whatever way you want to calculate, you can always decide whether such bond is worth investing or not. Similarly, if we could have gone by the IRR method, then that is a more accurate method, but it is a bit lengthy and effort consuming. In that case, we should have said that the current price of 920 and the return of 80 in the first year, 80 in the second year, 80 in the third year, 80 in the fourth year, and fifth year will be 80 plus the redemption of 1000. So whatever the discount rate is, which in this case was 10%, will, if all these inflows are discounted at the rate of 10%, then either the NPV will be zero or positive or negative. So if we ignore this 10%, and by the math definition of IRR, we know that it will be that discount rate at which the present value of all these inflows will be equal to 920. So if we calculate the IRR, then this IRR where the NPV of all returns, that is 80 multiplied by the PVAF, where the N is 5 and K is unknown, plus 1000 multiplied by the PVAF, sorry, 1000 multiplied by the PVF, and we know it is 5, it was also 5 here, and K we don't know, it shall be equal to 920. So here this K that will be equal to the IRR as per the IRR method will be equal to the YTM, and this will be approximately 7.5% as has been calculated above. But if there is any difference, then this is more accurate method of calculating and estimating the IRR. And so either way, we can decide whether the bond should be purchased or not, whether it is through the calculation of intrinsic value or through the calculation of the YTM, or the YTM is calculated by the IRR method, or otherwise it is the choice of the investor. And in this way, we can decide whether a particular bond is worth investment or not.